Well, good morning, everyone. We are here to talk about the 2025 Business Funding Guide. We're going to talk about the 27 mistakes that will get you denied for business credit and funding. So we could look at this in reverse. There's lots of small business owners that want to need money to start to grow to reach their potential. However, often they're not getting approved. So we're going to talk about what are some of the reasons that's typically keeping entrepreneurs from being quote unquote fundable. And we're going to also overlay that with the Fundable Shelf Corporations. As shown here on the screen, I'm with 509 Pacific. We're a 501c3 nonprofit organization. We are pleased to be administering a grant, and that grant, in short, is providing shelf corporations to entrepreneurs who are looking to have a fundable business. So this will all make sense as we get going. Let's go ahead and get started with today's topic. So why is this important? This is important because lenders and other types of credit issuers often are going to automatically decline applicants if you don't meet their approval standards. And that kind of makes sense, right? If you want to buy a house, you have to meet the underwriting criteria. If you want to get a car loan, you have to meet their underwriting criteria. Well, if you want business loans or business financing, you have to meet their criteria. It's just so often entrepreneurs don't know what those criteria factors are. Even more than that, a lot of it now is automated. So there's a lot of automatic approvals or alternatively automatic denials. So having the right information legally and ethically that meets what the lenders are looking for is crucial. And that is for those of you that have been around a while and maybe you've been looking for funding to start or grow a business, maybe you've applied, you haven't been approved, or you didn't get approved for all that you wanted. I think this is going to really hit close to home so you understand, maybe that's where I'm coming up short. Maybe that's why I'm not getting approved or not getting approved for as much as I want. Now, with that being said, there's a crucial point here, the fourth bullet on the screen. What I don't want you to think is, all types of funding are the same. There are different types of financing and loans, different types of lenders, and each have their own underwriting criteria. So today we're going to go through the 27 most common mistakes, but it's not really a checklist. You don't have to have all 27 items in good order to get funding because different sources of capital have different criteria. We'll work with you one-on-one to match you up to the right type of funding that you do qualify for. And if there's anything that's keeping you from getting approved, we'll help you with that, of course. But the bottom line is we have to be of the mindset, I need to have a fundable business. I need to be fundable on paper to get approved. There's not a lender out there that cares about how badly you want money or how badly you need money. It's about, are you qualified? So we're going to spend the next few minutes in going through, really a lot of it is documentation. How do we look on paper? Does our business have the proper attributes to get approved? But again, and anytime you see red, this is really important. It's trying to get your attention. So don't fret, be concerned as we go through this and say, well, I'm missing that, I'm missing this, I'm missing that, this isn't going to work. No, we're going to help you once we get through this presentation, then we'll work with you individually to address any credibility factors that you're coming up short on and or matching you to lenders that you do qualify. Of course, everything that we do is legal and ethical. So with that being said, let's go ahead and dive into mistake number one. Business name mismatch. One of the most common reasons for loan and credit card applications, I'm talking about business credit card applications being denied, is that the lender can't easily locate your business online. So we want to make sure that we know what the name of our business is And when we're applying, we're using the exact name of the business. We're not abbreviating, we're not changing it. Our business name is like our personal name. So we're not talking about personal loans, we're talking business loans. But if you were to apply for a personal loan, you would use your exact name. When we're applying for business funding, we need to use the business's exact name. So that should match up. In many cases, or at least in some cases, they'll look for documentation that verifies that that is your business name and you are using it. So it could be the formation documents of your business. It could be when you get your EIN, any licenses if applicable, bank statements, so forth. And then with online listings. So in general, it's a real simple rule. Make sure that our business name is matching everywhere. Simple enough, right? Might surprise you, but in some cases that has prevented individuals or businesses from getting approved. Mistake number two, not being in good standing. This is maybe a little deeper than what you think. So let's go through mistake number two. So being in good standing could often be referenced as at the state level and then at the federal, the IRS level. So at the state level, that's where entities are formed, whether it's an LLC, C Corp, S Corp, what have you. Entities are filed with a Secretary of State. So we need to make sure that our business shows that we're in good standing with the Secretary of State and to make sure it shows that we're active. Most states also require annual reports, and those annual reports may require you to pay a fee each year to stay active. There are some states that do not have corporate income tax, but there certainly is federal income tax. So I know that most lenders, if your business has been around more than the current calendar year, in many cases, lenders will ask for a copy of your tax return. So that would be another element not shown on the screen. So we need to be compliant and in good standing at the state level and then at the federal level. Now, sometimes it's easier just to hit the reset button and create a new entity that is in good standing than cleaning up a business that's not. And again, that's where a shelf corporation can come in. But let's proceed on to mistake number three. I have mixed feelings on mistake number three. We're talking about high risk industries. And while it is true that some lenders will automatically decline you if you're in a high risk industry, some examples of that could be ammunition or weapons manufacturing, bail bonds, check cashing, and so forth. So we're not saying that these aren't real, legitimate, legal businesses, but based upon the lender's perspective, they may be seen as high risk. And there are many others that are considered high risk as well. When I bring this up on mistake number three, it's not meant to suggest that we should lie or mislead. I mean, we are what we are. So whatever your business does, we shouldn't try to hide that, but it certainly is recommended that we at least consider the industry we're in can affect our fundability. Make sense? Nothing that we're going to discuss today is about how to game the system. We're going to talk about legal and ethical approaches to get funding. So, with that being said, we are what we are. You know, if we are running a gas station, it's a gas station, and we shouldn't mislead or misstate that we're not a gas station if that's what we are. But at the same time, we have to understand some industries are higher risk than others. And this, frankly, can be determined by the name of the business and also by our industry code. When we form our shelf corporations for clients, the shelf corporations are always set up as a management consulting firm. That's a very low risk industry, very easy to get funding. And really, it's not misleading anyone because you could do, frankly, any of these things on this page and also be a management consultant. So that's where it gets a little gray and you can use that to your benefit. All right, entity selection matters. So we're talking about having a business entity. So having a sole proprietorship is an example of not having a business entity. That means we're just out there applying as ourselves. But we're here talking about business funding and business credibility. So certainly having a corporation, C Corp or S Corp or LLC, is going to help us appear more credible. It's going to reduce our liability, and it's going to open up us to a larger amount of funding. There's two types of capital that we could raise, debt-based or equity-based. Debt-based is where we borrow the money, we promise to pay it back. Think of it as a loan or a line of credit. And then we have equity, where we have investors giving us money, not expecting to be paid back as a debt, but they expect to share in future profits. Investors certainly prefer C Corps in most cases. I think in general, a C Corp is probably the best way to go, but that is up to you. Now, you do not need to live in the same state that your business is formed. That's not a prerequisite. But the entity typically should be filed in the same state as the business address. And part of our approach, we see the red here, which highlights an important point. With our grant that we have for giving you a shelf corp, we will provide you a fundable and legally compliant entity. So if you already have this, great. If you don't have it, don't worry. It's provided for you for free. Mistake number 5, EIN. So some people say, well, I don't need an EIN because I don't have any employees. No. So every business should have an EIN, employer identification number, sometimes called a TIN, a tax identification number. It's to your business as your social security number is to yourself. Now, what interests me, I used to work at the SBA. I think a lot of you know this. A lot of people will go get their EIN first and say, oh, I've got a business. That is ass backwards. What we need to do is we need to first form the entity, which was the prior mistake we talked about. Once we have the entity formed, then we get the EIN. We're going to need that EIN to be able to open our bank account, to build our business credit profile like with Dun & Bradstreet and so forth. So having an EIN, it's free, but it is essential. We don't want to skip that step. Just like with the name mismatch earlier, we want to make sure that everyone has the same name spelled correctly, and we want to make sure everyone has our EIN correct and consistent. So very similarities in name and EIN. All right, mistake number 6, business address. Now, this is one that surprises more people. A lot of people are unaware of the relevance, the importance of business address. And I'll go further. A lot of people have opinions, but the truth is your opinion doesn't matter, nor does mine. So you and I are on equal footing. I'm not comparing you or I. The opinion that matters is the opinion of the lenders. What do they care? What are they looking for? Because they have the money that the borrowers are trying to get qualified for. So with that being said, address matters. And if you don't think it does, respectfully, you're mistaken. You're wrong. So in most cases, an address should be a brick and mortar building. Thus, a home address, not a good substitute. A post office box, not a good substitute. In many cases, lenders are going to look up the address. There's actually a database that has every address zoned as, is it commercial or residential, for example? Because some people say, well, I'll use my home address, but I'll put a suite number on it so it sounds like a business address. You're not going to game the system. Lenders are smarter than that. They're going to look at the address. Now, does it have to be a fancy building? No. Does it need to be a commercial building? Yes. We see people sometimes, again, they don't know what to look for, so they'll say, well, the building has to look really fancy or I can't get approved. That's ridiculous. They can't discriminate on how fancy the building is or what the zip code of the business is. So we need to focus on what matters. Now, just like with the name, just like with the EIN, consistency is crucial. So we need to make sure that our business address is used consistently at the state level, the federal level, the IRS, with the bank, on your website and elsewhere. That doesn't mean you don't do business elsewhere, that you don't conduct business elsewhere, but where your business is formed, where it's domiciled, is the address we're talking about. Virtual addresses used to be real popular, where you go into like a WeWork or these different types of shared office spaces. Virtual addresses typically are not acceptable by many banks and by some of the business credit bureaus like Dun and Bradstreet. I know when we first got started, we had a private office. We own now, but we leased initially. So we leased a private office, but it was in a shared office complex. So in other words, some people just had shared addresses where they would just come use a table, pack up their stuff, and then later in the day, someone else would use that same space. But there were also private offices. We had a true lease on a locked door private office. Chase Bank, we had a hard time getting approved for our bank account, even though we had been with Chase Bank for a long time, because that address was flagged. So addresses definitely matter. And with that being said, there are different types of lenders, as we've covered. Not all lenders operate nationally. Some operate within regions, some within states, some are county specific. And so, for example, we've done a lot with the Chapman Fund. We haven't talked about that recently, but the Chapman Fund will provide up to $250,000 for startups, but they care about the address. So address matters not only in compliance, but also different lenders are restrictive to some addresses. But the great news is with the Shelf Corp, we provide you a fundable business address. It's free, it's included, so no worries there. All right, so that takes us to mistake number 7. And again, this is another one where you might disagree, but respectfully, you're wrong. A lot of people think, oh, I'll just use my cell phone as my business phone number. Now, we're not talking about what number you conduct business on, but we're talking about the official phone number of the business, just like we were talking about the official address, the official name of the business earlier. So we do need to have a business phone number, even if you're just the only person in your business, and even if you work from home, which we've talked about some of the limitations of qualifying for funding if you do that, we need to have a business number that's separate from our cell phone. Could it be directed? Could it be ported to our cell phone? Sure. But the number itself needs to be a business number that's listed with directory assistance. We'll help you with that. That's not a barrier, but that is important. Now, some of you are younger than I am, and you might say, fax number, why would I need a fax number? It's interesting, fax numbers still are recommended in having a fundable, credible business structure. Mistake number 8, website and email addresses. In many cases, issuers of credit are going to research your company on the internet. And it's best if they can go to your website and learn about your business. Now, if you don't have a website, they're going to have to try to go find about your business elsewhere. So in most cases, not in all, but in most cases, not having a business website will hurt your chances of obtaining business credit and financing. Also, we want to have a business email address. We don't want to continue this practice of using Yahoo, AOL, Gmail, Hotmail, or other types of consumer email. That doesn't look credible. It's okay if you have those for your personal use, but for the business, we should not be communicating with others using those types of consumer accounts. Once you have a website, it's real easy to get a branded email. If you need help with that, we're happy to help you with it. That was mistake number 8. So as we're going through this, it is almost a checklist of what can we do to have the most fundable, the most credible business. But we always have to go back to the beginning. Remember, not all lenders require all these elements. So don't get distracted with that. All right, mistake number 9. We do need to have a business bank account. we do need to have a business bank account that's under the name of the business, under the EIN of the business, not your personal bank account. Not just that, oh, I have a Cash App account or I have a PayPal account. We need to have a business bank account, and we want to get that opened as soon as possible. The longer your business banking history, the better your borrowing potential will be. So when we're setting up these shelf corporations, we're going to provide you the entity, the EIN, all the paperwork. We're going to be ready to go get that business bank account immediately the next day, and we're going to encourage you to do that. Sooner the better. Now, you can have multiple bank accounts if you want. But most lenders of working capital loans, where in other words, they're wiring you the money. Let's say you applied for 100,000 or 250,000. So if they're wiring you the money, they will typically only wire it into the business's account. They won't let you circumvent it and send it into a personal account. So, with that being said, there's more than just having a bank account. We also need to be cognizant, we need to be aware of how much money is in the business bank account so we don't look insolvent. Now, this may rub you the wrong way because you might say, well, that's horrible, right? If I've got a brand new business and it's not fundable because it doesn't have enough money in it, what am I going to do? Well, it's true that it's hard for broke businesses to borrow money. But the good news is we have what's called the Opportunity Fund. So we can literally put money in, daily deposits into your business bank account legally and ethically. So that way the business account looks strong. So again, we understand that there's some common barriers, some common constraints that many early stage entrepreneurs will face. And I believe without exception, we found a legal and ethical workaround for each. So we do need a business bank account, and we do need to be concerned with how much money is in the business bank account. And if we have a lot of money, but we don't want to look insolvent, we can fix that if you need with the Opportunity Fund. Mistake number 10, business licensing. Now, this won't apply to all businesses, but if your industry is one in which that requires a license, then you need to have one, of course. And just like we've talked about before, if a license is required, then you want to go ahead and make sure that all of your licenses match up. Addresses, phone numbers, EIN, and so forth. So some licenses are like if you're a plumber, you have to be licensed to be a plumber. It's regulated. And in some cases, unrelated to the industry, there are just some cities, some counties, some states that require licensing or permits. You'll need to check to see if there are licenses relevant to your industry and or your location. All right, let's start talking more about less about the formation elements and more into the financial aspects, such as business credit. So we often see that businesses get denied because their business is not set up with the business credit reporting agency. So let's drill into that. So as individuals, which is not what we're talking about, we know that there's Experian, Equifax, and TransUnion, the big three. On the business credit profile side, there's a different set of credit reporting agencies that it's in our best interest to go set up our profiles. So take Dun & Bradstreet, D&B for short. We're going to help you get a DUNS number from Dun & Bradstreet because that establishes your business properly and thoroughly in their database, because lenders may be going to that database to check on the credibility of your business. So if you're not set up, that can be a disadvantage. And then what we're going to do is help you add trade lines, which we're going to talk a little bit more about in a moment on the next mistake. So we want the business to be established properly. Legally and ethically, we want it to look strong on paper. So when the lenders are doing the underwriting, they're making the decision to approve you or not approve you and for how much, that they see that you have a strong, stable credible business. Mistake number 12. So mistake 11 was having our business set up in the business credit bureaus. Now we want to talk about having a strong business credit score because, again, business credit, business funding is different than personal credit and personal funding. So in general, we want to, at least with Dun & Bradstreet and Experian Business, set up a profile and then add some trade lines. So in general, business credit scores go from 0 to 100. The higher the score, the better. We can quickly get anyone with an 80 or higher score. So we don't need a perfect score. We don't need 100 out of 100. We don't even need a 90 out of 100. But each of the business credit bureaus have their own terminology. So Dun & Bradstreet has what's called the Paydex score. So we'll work with you to get at least an 80 Paydex score. And then Experian Business, they don't have a Paydex score. Instead, they have what's called an Intella score. So I know it may be a lot of new terminology, but the concept is fairly simple. We want to establish strong business credit profiles for your business to optimize our ability to get funding. That's going to allow us to get better approvals, access to more capital. But again, we're going to help you with that. All right, so that takes us to mistake 13. Now, I know we're here talking about business credit and business funding, and sometimes people get irate when I bring up personal credit. They don't want to they don't want to think about that. They want to separate it, which I understand. However, different lenders have different underwriting criteria, and some of them, not all of them, will look at your personal credit scores as well as the business. So there's a different approach to it, and in fact, instead of your normal FICO score algorithms, there's a scoring algorithm called FICO SBSS. It takes into consideration both the business and personal side. The SBA requirements, for example, are relatively low, but we want to work with you and make sure you have at least a 165 FICO SBSS. Now, again, if you're not listening carefully, you'd say 165, well, that's crazy low, or that's not true, scores don't go that low. Well, you're thinking about consumer scores, not business scores. But again, at no cost through the grant, we're going to legally and ethically help you have a strong personal credit profile. The way that happens is no mystery. We will remove the applicable derogatories, the negative items, to take off the bad, add new positive credit, new trade lines, add good. So remove bad, add good, we'll have a high score, we'll get approved. Make sense? Okay, mistake number 14, collateral. This is a topic that I think most entrepreneurs are less familiar with, and that's exactly why we're having this conversation, because what we want is to have everyone on equal footing, regardless of your education, your background, your location. We want everyone to have a common base, a common foundation of knowledge of what does it take to get business funding. So, collateral. In the case of business credit, collateral is often not an issue. In case of business loans, it typically is an issue. So collateral is defined as the assets that you're pledging in case of default. So in other words, if your business doesn't repay the business loan, what can the bank or the lender do to mitigate the risk, to not lose everything that they loaned out? Again, different lenders, different loans have varying collateral requirements, but for business loans, typically we're going to be looking for dollar collateral. You might say, well, that's a problem. I've got an early stage business. I don't have enough collateral. Not a problem. Again, we have what we call the collateral support program. So when you get a shelf corporation, we literally are transferring legally and ethically $100,000 to you right away, typically within 24 hours. So you'll have the collateral for the business loan. And then that collateral in the form of accounts receivable, it's real, it's not pretend. And so then we can liquidate that AR to turn that into cash, put that into your bank account. Because remember earlier in our discussion, we said bank accounts matter and bank balances matter. We talked about the opportunity fund, which is different, but another way that we help participants in the grant program have cash on hand is by liquidating the AR. All right, mistake number 15, business plans. If we're just trying to get business credit cards, they're typically not going to ask for a business plan, but most traditional business lenders will want to see your business plan to understand what do you do, how much money do you want, what are you going to do with it, can you afford to repay it? So different lenders have different criteria, but we need to not just look at business plans as something that helps the business owner figure out what they're going to do and how they're going to accomplish it, but also for the loan package. So we're going to help you create a business plan, but we do it in 2 phases now. It wasn't always like this, but we do it in 2 phases. The first thing that we're going to do is just address 7 questions. 7 simple questions that you give us the responses. We call them the prompts. So that gives us a common understanding of where you're going. Not a lot of detail, but a high level. Then we move into a very sophisticated software program that we provide each grant participant for free. It's the same software that we used when we worked at the SBA. And then we can build out the full lender plan. But as far as the 7 key prompts, so that's a question like, well, what's your use of funds? How much money do you need and what are you going to use it for? So there's 7 key prompts that we'll help you with. Once we have that nailed down, then we can move in and help you create the full lender compliant business plan. So business plans are important, but you don't have to bring that to the table. We're going to help you create that in a compliant way. Mistake 16, financial projections. Now, financial projections are also often part of a business plan. But we do need to have financial projections. Typically, we're going to project out month by month for 3 years, 36 months. And on our Zoom training tomorrow, we're going to actually go through an example of financial projections. So you can join us tomorrow if you'd like. So there are different lenders, and different lenders may have different requirements, but we have a setup through the software, which we talked about here at the bottom of the page. So our business plan software has the financial projection tool that works very well. And so we're going to help you with that. And the purpose is to show the lender that, yes, you can afford the loan that you're requesting. That from that, we'll be able to inject that money into the business, we'll make money, and we'll have enough money to pay the loan back. Because, of course, lenders want to be paid back. Mistake 17, use of funds, and that's part of the business plan I made reference to a moment ago, but this is so important that we need to drill in more thoroughly. So most business loans are going to require a use of funds, and this is essentially the shopping list of what it is that you want money for. You would almost snicker if you sat at my desk for a day as I work with clients, especially on our new clients on the onboarding. We'll ask them, well, how much funding do you need? And a lot of times they don't know. They're just kind of pulling a number out of an orifice. But it shouldn't be that way. We should know, what do we need for our business? What does each of those items cost? And if we add all that up, then that is our use of funds. Now, it's more important than just calculating a number. Where we go for funding is going to be greatly influenced by what you need to spend it on, because there's different lenders that have a different palette for different uses of funds. And so, for instance, there's some lenders that like real estate, some that like restaurants, some that don't like real estate, some that don't like restaurants, just as a simple example. So the use of funds is crucial for us and finding the right lender for your mitigating circumstances. We're going to help you put that together. And at the highest level, we'll need more detail, but at the highest level, we're looking at, okay, how much money do you need for working capital, marketing, payroll, advertising, so forth? How much do we need for equipment? And if it's equipment, let's make a list of the equipment. How much do we need for real estate? If some of it's for real estate, what are the specifics? Are we going to acquire? Are we going to do an acquisition of another business? Okay, great. Let's include information about it. So we'll work through this with you, but it is important to understand that we don't just go to a lender and say, I want $3 million and not give them an explanation. That's not going to work. We're going to need to give them an explanation through the business plan that incorporates the use of funds. Industry experience. People don't like to see this, but we need to go ahead because we're being transparent with this 27 mistakes and loading you up with what you should already know, but if you don't already know it, you need to be aware of it now. So different lenders, as we've said, have different underwriting criteria, but some traditional lenders, they want to see that you have industry experience. I'll give an example. When I worked at the SBA, I had a father and son that came in. The son, adult son, the son was a welder, very good at his craft. The father had the stronger credit. Their approach was to come in and work with us to get an SBA loan, whereby the father was the only one on the loan paperwork because the father had a stronger credit profile. Well, we couldn't get it approved, right? Because the father's not a welder and we're borrowing money for a welding business. So experience matters for some sources of capital, granted, not all of them. So the same with food trucks, with most industries. Now, if you're wanting to go into something new that you don't have a background in, that doesn't mean that it can't be done, but it's going to affect how we build the package and where we go for funding. So having a biography, like a resume that would highlight your education and relevant experience. And again, we're going to help you with that. We're going to capture that actually in the business plan, so it's not a standalone document, but that is relevant. It is important. All right, mistake number 19, advisors. Maybe you haven't considered this, but I hope you will after we go through mistake number 19. So it's good to not go it alone, to have a team of advisors helping you. And we want to be in the mindset that you're the CEO of your business. You're not just an individual. You're the CEO, you're owning and operating a business, and so we should have a team of advisors, such as a CPA. Now, do you have to have a CPA? No, but it's recommended, someone that's going to help you plan for taxation issues, prepare your annual returns, and so forth. You most likely will want to have a business attorney. Many of you may want to consider having a business coach, someone that works with you after funding for the implementation. Like, okay, now you've been funded $1 million. What do you do now? So that's not our role. Our role is to get you a fundable business through the Shelf Corp and get it funded. Then someone else would be working with you from that point forward, often referred to as a business coach. You may want to have an insurance agent, and we'll actually talk a little bit more about insurance. While that's not a real popular topic, having insurance is an adult thing, right? It's part of being an adult. It's part of owning a business, and you may need an insurance agent to help you. And then where we come in, we're what's considered technical advisors. All of our team are what we call business paralegals. So we have the background, the education in business, the background, the education in law. So we're able to help you put the package together. So those are 5 different examples of advisors. Do you have to have them? No. Is it recommended? Yes. Mistake 20, feasibility data. This may sound a little abstract or vague to you, but when you and I are putting together the business plan for your business, now with the Shelf Corp, granted, it already comes with a business plan. It's already created, ready to go to funding. But if you're doing a one-off, if you're doing not a Shelf Corp, but a separate custom build, then the data is going to need to be substantiated to justify that what you're saying is true, that your assumptions are true. We have already done that for the Shelf Corps, but just keep in mind, just because you put something on paper doesn't mean that the lender is going to say, oh, that must be true. So having feasibility data comparing your projections to your industry norms is important. Again, we've already taken care of that for you for the Shelf Corps. Need to know your target market, mistake number 21. So not all lenders care about your target market. Traditional business lenders do. This is your explanation that you know who your customers are. And maybe that seems so obvious to you that that seems ridiculous. But the lenders don't see things through your eyes. They're this independent third party that's taking the risk of loaning you hundreds of thousands or millions of dollars, and they need to understand your business. So one of the elements that we include in the business plan, which is already built in, by the way, for the Shelf Corp, but if you're doing a one of one, we need to figure out who's your target market, research them, how many are there, and so forth. Again, you can see why the Shelf Corp is so attractive because all of these elements are already incorporated. They're already built in, already done for you. But regardless, we're going to need to demonstrate that we have a clear knowledge of who your target market is, so lenders will have more confidence in your business. Mistake number 22, historical financial statement. So let's pause for a moment and think about financials. So here we are today. So if you stand up and you look down at your feet, this is where you are right now. And if you extended your left arm out, that's the past. And then if you extend your right arm out, it's the future. So financial statements, we need to keep in mind the difference between where we're at now and the past. We'll call that historical versus the future, which are projections. So often we'll have clients that say, well, no, I have a new business or I haven't done anything yet. I don't need financial statements. That doesn't apply to me. And that's not true. And I hope to never hear that again because of us doing this training for you today. Financial statements are relevant even for brand new businesses. And if you disagree, respectfully, you're wrong. We should be able to create a balance sheet on the same day that a business is created. Now, again, with the Shelf Corp, we're providing you the balance sheet. We're providing you the financials. But if you're doing a one of one, you're doing a custom build, we need to put together historical financials. Now, when it comes to creating these financials, again, it depends. Is it a projection or is it historical? For our projections, we're going to take care of that. And actually, your projections are already built out for the Shelf Corp. It's already done, ready for you. But if you're doing a one of one, we're going to need to build out what things are going to look like in the future. And then in terms of where we're at today and the past, what got us to today, normally we're going to want to use some sort of accounting software like QuickBooks. Because to create historical financial records by hand is painful and often it won't look very professional. So I do recommend that small businesses subscribe to QuickBooks or something like it. I don't sell QuickBooks. I don't get paid for it. I don't get kickbacks or anything. But QuickBooks is the nation's most widely used small business accounting software. We need to build it into the budget. We need to have QuickBooks so we can manage our money properly, which we'll talk more about in another mistake. Now, if you say, oh no, I don't know anything about numbers, I just want to run my business, that's fine. You can outsource that. Remember, we talked about our team of advisors a few minutes ago. So you could have your CPA take care of your financial statements if you don't want to do it internally. But yes, please don't fall under this excuse. Well, I've got a new business. This doesn't apply to me. That is flat out wrong. You're kidding yourself. We should have financial statements, but we're going to be able to build those financial. Well, they're already built. If you're getting a Shelf Corp, the financial statements already exist. They are ready to be submitted for lending. If you're wanting us to help you with a custom build, then we can do that as well. We're always going to do legal and ethical, but there are some very innovative ways to really strengthen financial statements, even for a new business. Mistake number 23, and we talked about insurance a moment ago, and insurance is that topic pretty much no one wants to talk about, but it's relevant, so here we are. You're going to need insurance. I guess I'll just need to come out and just say you're going to need insurance for your business. And if you don't have money for insurance, and I don't sell insurance, by the way, but if you don't have money, then we'll raise the capital for this. But just like we need QuickBooks in general, we're going to need insurance. Well, what kind of insurance would I need? Well, if you work with clients, you'll need an E&O, an errors and omission policy. I know we have one. I suggest you get one as well. It protects you. If you have partners, you're probably going to want to have a buy-sell policy. If you have employees, now all of a sudden you have workers' comp and health insurance and retirement and all these other elements. So again, running a business is actually fairly complicated. I think some people confuse being a hobbyist with being a business owner. We're teaching, we're preaching, we're assisting you in creating a real business that's going to be profitable, that's going to have possibly great wealth creation, but we need to run it like a business. So again, different than personal policies. Sometimes people ask us about key person policies. I don't know if you're familiar with those or not, but a key person policy is a policy that's owned by your business. The business is the beneficiary, but you're the insured. So that protects the lender. So if you should die while the loan is outstanding, then there's money coming in to pay off the lender. Don't want to get too deep into the weeds, but is insurance important? Yes. And we talked about having one of your advisors as an insurance professional. Mistake number 24. We're almost done. We're going through 27 mistakes. We're on 24. Inadequate cash contribution. Again, different lenders have different requirements, but if we're going to go borrow from a bank for a traditional business loan, whether it be SBA or not, normally they're going to look to see if you have 10 to 20% of the quote unquote project to contribute. They typically don't want to loan 100% of the money. They want to loan normally 80 to 90% of the money. Now, it doesn't mean that you have to spend your portion, but we need to show that you have it for contribution. So let's say that you wanted just a simple $100,000 working capital loan. Would the lender loan you $100,000? Typically not. They would normally loan you $80,000 to $90,000, expecting you to put the 10 to 20 in, which you don't technically have to do. It's just they would fund 80 to 90% of the requested amount. Again, I see a lot of folks, oh, I don't have this, this isn't going to work. Well, no, there's a workaround, legal and ethical workaround for anything. We can do one of two options. We can layer in and we can build what we would call the contribution from an earlier round of capital raise that doesn't require that. Or again, as we talked earlier, we can use the opportunity fund, start making those daily deposits. It's designed to put $1,000 a day. It could be more, but it's designed to put $1,000 a day into your business bank account so we can have a strong bank statement, which we talked about earlier, but also have our cash contribution. But in many cases, it's a mistake to think that you're going to borrow 100% of what you need. Lenders are going to typically look for you to have some contribution. Not all lenders, but that's the norm. So we don't want you to be surprised by that. Also, we're providing you the $100,000 of AR. Remember, we talked about that earlier for collateral. We can liquidate that AR, turn that in cash, and then you would have $100,000 of cash to contribute to your project, quote unquote. Make sense? Mistake number 25, and this kind of blends together a number of the different elements that we've talked about, but we need to run our business like a business. And it's okay if you've not done it before. It's okay if you don't have the experience or education, but we just need to go into this with the right mindset. So what are examples of not running a business like a business? Well, if you're not using QuickBooks, we talked about that earlier. We need to manage the money that's coming in, that's going out, to be able to generate reports. If you're not using QuickBooks or something like that, you're really not running your business like a business unless you're using, of course, your CPA to do that for you. We believe that you should be set up as a salaried W-2 employee of your business with appropriate tax deductions. Some people think, no, I'm self-employed. That's not the way it works. That's wrong. You should run your business like a business. We'd recommend using QuickBooks Payroll. Set yourself on direct deposits every Friday. Figure out what your weekly pay is, 2,000, 3,000, 4,000 a week, whatever you want, something reasonable. Have taxes withheld. That's the right way to run a business in most cases. So we don't want to be self-employed. Some people will say, I'm self-employed with pride. You and I look at them like you're a fool. You never want to be self-employed. You want to be a W-2 employee of your own business, but you want to be a W-2 employee. So again, as we go through this, I realize there's a lot to running a business, but what we can do is get you a shelf corp. We can get you $100,000+ We're confident that we'll guarantee that. But we need to understand that we're going to be running a business. We're not just a hobbyist with that type of money. So you have to make a decision. Am I at the point in life that I'm ready to own and operate a business? All right, mistake number 26, the wrong business for your circumstances. This one often doesn't get well received. But again, my job today is not to make you like me, but to give you the information so you know. So with that being said, regardless of your education, your experience, your passion, your interest, we recommend working in reverse. Let's figure out how much capital you have access to and then build out your business plan to match your circumstances. Let's say you came to us and said, well, I want to compete with Elon Musk. I've got this great idea for a new EV, electric vehicle, and I'm going to compete with Tesla. That's going to take billions of dollars. Am I saying that you're not worth or you don't qualify for billions of dollars? No. But that's a tall order, right? That's a large amount. So we know we can get any client at least 100,000. We're sure of that. The process is 100% certain of getting you 100,000. Can we get more? Can we go up to a larger amount? Sure. Our typical clients are going for 1 to 5 million. Once we get above 5 million, it gets really difficult. Not impossible, but it gets really difficult. Some people say, I want max funding. Well, I don't even know what the fuck max funding is. There is no max, but we have to qualify, right? We have to qualify for the amount we want, and we probably need to be honest and accurate and look at our situation. But 100,000, not a problem. The larger the amount, the more credible your file has to be. And that kind of makes sense. It'd be too good to be true otherwise. Last mistake, number 27, kind of links to the prior, is going after the wrong source of capital. I'll have many clients that come to me even before we've built anything out, and they'll tell me the type of capital they want. And often it's just because they heard it from someone or they saw it on CNN or Bloomberg News. We need to realize there's different sources of capital, each have their own underwriting criteria. So we need to find the right type of funding based upon your circumstances. Now, the beautiful thing is if we're doing a shelf corp, it's all built, it's a business in a box. We know what works, it's ready to go. We'll be applying for funding for you next week. But if we're doing a custom build, we need to be very thoughtful about where are we going to go for the funding. And then understand the criteria, because there's got to always be underwriting criteria. We need to meet that underwriting criteria. In some cases, we're going to have to layer in. In some cases, we can't just get all that we want in one round. We may have to go after multiple rounds, tranches, layers of capital. So again, 100,000, feel 100% confident in getting. We can pursue more. We typically are pursuing 1 million plus, but the larger the amount, the more credible we have to be.